Well, welcome. I'm Tom Turk. I'm the Dean of Chapman University's arduous School of Business and Economics, and I'm delighted to welcome you to Tearing Down the Pink Wall. We've got an incredible panel discussion of leaders, women who are leaders in financial services industry, where they're going to give up their perspectives on the current investment environment and careers. Collectively, these women represent firms with over $2 trillion in assets in management. And we're honored to have been invited by WISE, Women Investing in Security and Education, to be a co-host of this event. It's really been a special year here for everybody with the events going on. And at Chapman, I think we've had a chance to have a significant impact on the community with through editorials in the Wall Street Journal. We've been leading the debate on Biden tax increases. We're against them, incidentally. We've also published a number of great research on the economics of COVID public policy. We've led the discussion on revitalizing the business environment in California. And most of all, actually, we're proudest of the launch of our Master's of Science in Real Estate program this year. It's a collaboration with the business community that has resulted in all of our students had jobs at graduation with average salaries 50% above before they got there. In fact, our Master's of Science in Accounting also all had jobs at graduation, as did our Jane's Financial Residency program. So it was a great year for having an impact both on the business community, and the students, and our alumni. And so we're proud that for events like this is making it all possible. It's this collaboration with leaders in the business community that I think has distinguished us and provided these opportunities to our students. So once again, I want to thank WISE for inviting us to participate in this. I'd also like to thank our other community partners, Eaton, Vance, and Peyton Regal Investment Management. We're delighted to have you help with this event as well. So to kick this off, I wanted to introduce Angela Daly, who is the Executive Director and a member of the Board of Directors of WISE. Angela is a founding partner of DAI, which is a strategic communications company focused exclusively on financial services firms. Before that, she was an SVP and member of the Board of Directors of Drexel Burnham Lambert, where she headed their global communication strategy and did so in a particularly challenging time for those of you that remember. Angela, thank you again for making us a part of this event.
Well, thanks, Tom, for the kind words and for partnering with WISE. It's such a pleasure working with you and your team. Hello, everyone. Welcome. And let me add my thank you. I'm Angela Daly, Executive Director at WISE. If you're not a member of WISE, please go to our website, sign up. The price is right. It is free. In 1997, a small but powerful group of women met in Orange County to put on an investment conference for women. To their absolute amazement, over 500 signed up for that event, and they knew they were onto something. Let's fast forward almost 25 years, and WISE remains true to its mission of financial empowerment to females of all ages and all socioeconomic backgrounds. We work with we partner with community organizations such as Girl Scouts, Girls Inc., and universities. And every year we reach thousands of females of all ages on a whole variety of financial topics. Tonight's event is part of our groundbreaking Tearing Down the Pink Wall series, whose mission is both education and inspiration. We gather the best and the brightest in financial services to educate us and inspire us all to reach our full potential. And that is exactly what we have tonight. The best and the brightest. We have three financial world influencers on our panel. We have Jana Barton, Eaton, Vance, Sonali, Pier, PIMCO, and Ellen Lee from Causeway Capital. These women are part of a verified group. According to Morningstar, only 11% of all portfolio managers are female. And the sad thing about this number, even sadder thing about the number is the number, but It has not moved in a decade. And in fact, some studies show that here in the US, it's trending the wrong way. So tonight we have, as Tom mentioned, we're going to hear market insights, and then we're going to hear about these fascinating career journeys that took these women to the absolute pinnacle of the financial world. But before we do that, it's my great pleasure to introduce Consuelo Mack, my good friend, who has been involved with this Tearing Down the Pink Wall series since its inception about 6 or 7 years ago. And she is really a very important part of what makes this series unique. Consuelo is a pioneer in financial journalism. She is one of the most respected and admired financial journalists in this country. She was an anchor at CNBC and now hosts her own show, Wealth Track, on PBS, whose mission is to help all Americans build and preserve their wealth. She's a fierce advocate of females in the financial world, and this helps as many ways as she can, demonstrating she's here with us tonight. So please join me in welcoming Consuelo and our distinguished panel. And one bit of housekeeping, please put your questions in the Q&A box, not the chat box, and we'll take them at the end. So Consuelo, showtime.
Thank you, Angela, my dear friend. And I have to also tell the audience that I've been involved with WISE for many, many years. And Angela, I think I was responsible for getting you involved, which was the greatest contribution that I could have made to WISE. You are now the executive director, so you've just been a miracle in my life and also the lives of so many others, especially with the philanthropic work that you're doing. So I also want to thank the Chapman University School of Business. And Tom, glad to hear you writing those editorials for the Wall Street Journal, which was a longtime former employer of mine. And also want to thank WISE for sponsoring events like this and the Tearing Down the Pink Wall series. And I'm just so delighted to be here and to be part of it. And I'm also so honored to be here with 11% of women being portfolio managers. It is shocking in the financial services industry, but I think that's going to change. And when I introduce our three panelists, you'll understand why. And they are powerful women in finance, and they are going to share their perspectives on the investment climate and their careers. And we are here with a common mission, which is financial literacy. Actually, two common missions. One is financial literacy, which is what WISE is all about, and also preparing women for leadership roles in the financial services industry, which is what our three panelists represent. And this is not just for women, it is for everyone. Just want to make that clear. And financial literacy is basically the key to financial security, which is a critical component of a successful personal and professional life. It's so important as well to mental health and well-being. And leadership in the financial services industry, I've been watching it for a long time. That's where I started out as a broker many, many years ago at Merrill Lynch. And it's opening up to everyone. And it doesn't matter, what you look like or where you come from. Basically, if you've got the talent and you've got the ambition and you've got the work ethic, it is wide open. The opportunities are there, which is why it's so great to have these three panelists discuss what their career trajectories and path have been. So let's get started and meet the panelists. I know that there was a scroll that you saw, the accomplishments, the professional accomplishments of all three of them, but I just want to quickly run over them because I think it's important to understand what they're doing and how influential they are really becoming in their respective specialties. So Jana Barton is Director of Specialty Solutions at Eaton Vance, portfolio manager on a number of Eaton Vance tax managed equity portfolios, which we'll talk about to Tom's point about possible tax increases, and also specialty offerings. And the neat thing about what each of them is doing is that it will introduce you, the audience, to how many different facets there are in the financial services industry. I mean, it really, there's a place for anyone who, would be interested in a dynamic and growing industry. She's a member of Eaton Vance's Equity Strategy Committee, a member of Morgan Stanley's Global Diversity Council, Morgan Stanley has recently acquired Eaton Vance, and also founding member and first chair, this is important, of Eaton Vance's Women's Leadership Exchange. Undergrad in business administration at the University of Florida, and the undergraduate degrees, you'll find out why I'm mentioning them. And also a chartered financial analyst, which is a really tough designation to get, but she is a CFA. Ellen Lee, next, director and fundamental portfolio manager at Causeway Capital Management. And for those of you who don't know Causeway Capital Management, it's California based. It's a global independent majority employee-owned value-oriented equity firm with $45 billion in assets under management. She is responsible for investment research in global consumers and utility sectors. She's formerly covered the transportation and auto industry as well. Lots of international mergers and acquisition experience. Undergrad business administration at the Seoul National University, and then went on to get her MBA at Stanford, which I'll ask her about in the career section of our conversation. And as far as some of her philanthropic activities, she is on the Audit and Investment Committee of the Center for Early Education in West Hollywood. So important that we participate in our communities as well. Sonali Pier is Managing Director and Portfolio Manager at PIMCO, focus high yield and multi-sector credit, which means basically corporate debt. Member of the Diversified Income and High Yield crossover teams, rotating member of PIMCO's Investment Committee and America's Portfolio Committee, both of which are very prestigious at PIMCO. Experience as a senior credit trader as well. Talk about how rare women's positions are in the trading field, where she worked at JP Morgan and cash, recovery and credit default swaps, and an undergrad in economics at Princeton University. And Morningstar named Sonali the winner of its 2021 U.S. Award for Investing Excellence in the Rising Talent category. So it's so wonderful to have you three here. And as I mentioned, it's going to be a two-part conversation. The first part is going to be about the investment climate outlook, what they're telling clients. And then at the end of that section, we're going to get their top investment recommendation. We'll ask each of them for that, for you. And then the second part of this conversation is about their career journeys. And we are going to get their top career advice as well from each of them at the end of that conversation. And during all of this, we are encouraging you all to submit your questions. And then WISE member Nella Webster will be fielding those for us. And in the final half hour of the program, we will be taking questions from you. So let's start with the macro backdrop. And, I run a program called Wealth Track on public television. It's a weekly investment program. And there are so many things that we're tracking. And I'm really interested to hear what each of you thinks are kind of the top macro issues that you all are talking about in your firms. So let me just give you some examples of what we're tracking, and then you can take your pick what your firms are really focusing on. But needless to say, we're seeing economies reopening and growing around the world. Inflation, it's the highest since the 1990s in the US. A lot of you have never experienced higher inflation. Interest rates coming off 4,000-year lows. You heard me right. Interest rates are currently at 4,000-year lows in much of the world. And for the first time in 40 years, we're starting to see an uptick in interest rates. Shortages, everything from supply chains to energy to labor. We are seeing unprecedented shortages in all sorts of areas. Unprecedented monetary and fiscal stimulus. We've got record levels of corporate and government debt globally. We've got booming investments in the stock markets, in the bond markets, and alternative markets, private equity, real estate, cryptocurrencies, you name it. It is a very exciting and unusual macro backdrop that we find ourselves in. So what are the 1 to 3 top topics that you each are talking about in your respective firms? So Yana, I'm going to start with you. What are you talking about at Eaton Vance?
The short answer is all of the above. Great to be with you all this afternoon. Thank you so much for having me. But you are absolutely correct, Consuelo, and that is over the past 12 months, we've seen an incredible recovery in the equity market that has been driven by this reopening post-pandemic world that we found ourselves in 2020, where global economies on average collapsed and declined over 4 percentage points. And here we are just shy of 2021 being over, and our own US economy is expected to grow in excess of 5.5, maybe close to 6 percentage points. So on the heels of that global economic recovery, the equity markets or risk-on markets and asset classes have done exceptionally well. As we sit here today, the S&P 500 is up in excess of 23 percentage points year to date. And just to provide some context, of the past 10 years, the S&P 500 has generated a little over 16 percentage points, which is also almost 6 percentage points higher than the previous 10-year average. So we've generated a lot of returns driven by very concentrated and narrow leadership, which gets me to the point that you were asking. And what we are focused on is the next 3 to 5 years are going to be shaped by an environment that we believe will witness higher rates, interest rates, higher inflationary pressures, mixed economic global backdrop, and very much dynamic fiscal and monetary policy. And within that backdrop, I think an investor that is balanced and selective will do very well. And while we're very constructive on equities as an asset class, I think one needs to continue to be diversified and quite selective in their long-term posturing. So good things ahead. The markets always climb sort of this wall of worry, but it pays to be patient and selective.
Ellen, from Causeway Capital's perspective, which is an international value manager, what are the top macro events and developments that you're watching?
I would echo what Yana said in terms of all the key topics you mentioned, Consuelo, are very topical, but I would point, shed light on 3 things in this forum today. 1 is inflation, and 2 is supply chain, and 3rd would be reopening or normalization of economy. Those are 3 themes that we think are super important for managing a portfolio like ours. At Causeway, we pride ourselves in stock selection ability, and we take a concentrated position in our portfolio for companies we believe in the longer term will outperform the market. So a lot of our investments are based on bottom-up equity stories. So with that backdrop, I'm looking at inflation, on trying to find consumer companies who are going to be able to pass on those pricing pressure onto their customers. It is a real test because none of the consumer companies have really experienced any form of inflation in the last decade to a degree. But the companies are saying they can do this because at every part of the supply chain, they're seeing increases, but the jury is out. So on the second point on supply chain, this is a real head scratcher, I think, for everybody in the industry, because to make it a little bit more tangible, when we talk about supply chain, we see the ships, congested, or the ports are congested, so our goods are sitting in the ships. So that's one way supply chain is breaking down. But taking a step back, the global supply chain is so specialized that, and also in the last 10 years or last 20 years, globalization has really accelerated the specialization and just-in-time management and production. And so, we've really benefited from, technology to really execute this just-in-time management. But the pandemic brought this sort of jolt in the system. So we're at a period when there's been a jolt, supply stopped, and then when it restarted, it was another jolt for the demand to pick up. And I think the confusion in the market today is people don't really know where the excess inventory is or where the pain points are. And again, drawing back to the global supply chain we have today, I think there is a lot of uncertainty about who's well positioned. So that's another issue that we're talking to our clients a lot, and talking to the companies and actually working collaboratively with my colleagues that cover different sectors, I think is enabling us to have good global insights. But again, this is really, really topical today. And then the third point that I wanted to mention is this reopening trade that is widely talked about. So COVID is really bad still, but I think especially in developed markets, we're seeing vaccination rates go up, and that is bringing forth some sense of normalcy, and people are slowly going back to work. Kids are back at school. So I think some things we've experienced in these developed markets as areas where, human behavior is stickier and some things have not permanently changed. However, in the stock market, we see that there's a lot of questioning about corporate travel, how much people are going to travel, especially for business. And also, is Yana going to be working from home 5 days a week or 2 days a week? And that really has ramifications for companies who are engaged in, let's say, catering business or running cafeterias. So we think that part of the market, there's a lot of skepticism about normalization. So at Causeway, our approach has been, okay, during a crisis, let's find opportunities where the market is overly pessimistic. But at the same time, because structural changes can happen, let's try to find the winners that even in a smaller portion of the market who will take down competition to actually excel. So those are some of the, themes that I would work toward to actually provide a basis for good stock selection. And that's what we're doing at Causeway.
This is why the financial services industry is so fascinating, because basically you've got to think about a lot of things that are going on that don't seem particularly related directly to the financial markets, but they really are. So Sonali, at PIMCO, what are the top, 1 to 3 topics that you guys are discussing?
Yeah, I think, both Yana and Ellen have hit on some very important topics. So from a macro perspective, certainly we're discussing, growth and how it's been uneven on a global perspective. So developed markets have, growth nearly peaking, while emerging markets are in kind of after having significant growth prior to COVID, in a much different position given the different levels of vaccination rates and the different levels of dependence both on energy, tourism, and of course, where they are in the pandemic cycle. But what this means for also inflation, and then as a result, monetary policy, and the likelihood of the Fed to be either lagging or trying to respond to inflation, and those policy missteps that are possible, alongside a big infrastructure bill and also fiscal spending, and so kind of figuring out where the balance is there. Other issues and more on, from a micro perspective, but also from a macro perspective in terms of how it all builds up. We're looking at, the employment picture where, previously many had thought come September with benefits rolling off here in the US and students back in school that we would see a rise in employment as parents get back to work, as well as those who needed income post benefits. We haven't seen it materialize in quite the shape that we were hoping. Issues like, Ellen had mentioned some of the supply chain issues. Some of that is also a result, and she mentioned some jolts, but the fact that we were such a heavy service economy prior to the pandemic, and we all had made shifts that turned us into strong goods demand. For example, switching that gym membership perhaps into a Peloton, or rather than going to a restaurant, maybe consuming staples that had seemed, that they were going off trend in terms of packaged goods and the like. And so, there's a lot of switches that were made, and now the economy is kind of not ready for the switch back per se. And this isn't even yet at the full global scale in terms of, developed markets are ahead on that reopening versus emerging markets. And in, we just finished our secular forum, which we do annually to assess kind of what are the impacts over the next 3 to 5 years. And we bring in outside speakers to really help, mitigate any sort of unconscious bias or groupthink that we might be having, and, really introduce some of the experts in each of these areas externally. And some of the topics that we're discussing as a result are inequality and populism as a result, and how that could have an impact. Some of these shifts from where currently it seems like employees are in the driver's seat, but could it shift back to employers as work from home works, and therefore it could be outsourced over time. There's a lot of, we have to take a lot of humility here, because there's a lot of shifts that are happening, and it's very unclear kind of where the end result is, despite where we are today, which seems pretty clear. And then the last thing I'll mention is, ESG. This is something we haven't talked about yet, but the impacts of environmental, social, and governance impact investing. We've seen while the percent of, say, securities that are dedicated to this still is relatively small, the trend is very clear, and the growth has been pretty significant. And so the transitioning from, say, brown energy to green energy will also lead to a lot of different, call it a lot of uncertainty, meaning fatter tails to the distribution. Right. Even if, we can identify a base case, I think, again, it comes back to that being humble and realizing that there's a lot of different nodes and starts and stops that can happen along the way to such transformations.
When we have been living with this, the four of us, and many of our audience has as well. But if you step back, I think you all kind of pointed this out. This is really an extraordinary transition that we're going through in the global economy and in the markets. And certainly, as I mentioned, interest rates peaked 40 years ago in 1981, and I think the 10-year Treasury was something like 16% or something, or even higher. But the point being that we've had 40 years where very few people on Wall Street remember what it was like when interest rates were rising, or remember what it was like when prices went up day after day. So we are really seeing some seismic shifts that are going to be with us for a long time. I'm going to ask each of you. Again, the view of your firm is the Federal Reserve is talking about the rise of inflation being, is it transitory or possibly permanent? What's the view, just quickly, from each one of your firms? And are they transitory or more lasting as far as the uptick in inflation? Yana, do you want to?
Sure, I'll kick us off. I don't know if this is the firm's view, but it's just my point of view. So take it for what it's worth.
That's great. I think your point of view, probably even better.
I think there are pockets of inflation that will be with us for years to come. I think, when we talk about wage inflation, you can't give somebody a raise and then take it away. I think there will be lingering impacts of all the supply chain inconsistencies and shortages we're dealing with, and the impact it has on freight and cost of moving goods, and the longer term sort of lingering effects of kind of right sizing your structure, sort of flex versus your fixed cost structure, and the impact to the business. So I think, in short, it depends to be seen in aggregate what the impact will be, but I think it will be higher than most folks would like it to be, particularly relative, exactly what you said, Consuelo, when comparing, contrasting to decades past.
Right. And Ellen, I know Causeway doesn't make big macro calls, but give us your point of view regardless. I know you're an equity investor and you do bottom up type of research. So, but what's your thought on inflation?
So I think, if I had my crystal ball, I do think we're ripe for an environment where rates could slowly rise as inflation, some of it sticks. But can it go back to the levels that we think of 10, 15 years ago? I am a little bit skeptical on that, because, the global growth is markedly lower than what we had anticipated because emerging markets actually took a step down in growth, if you look at the past decade versus the early 2000s. And then the second point I would make is that, governments can't really afford rates to go up, quickly anytime soon, because that would be detrimental to all the government balance sheets and especially I think during the pandemic, as you mentioned earlier, Consuelo, it's become, a lot of the debt has gone on the balance sheet of the countries, the sovereign debt. So I would, point to those two things to be cautious about any short-term spikes, but gradual rise, I think, does make sense. On inflation, I do think there are pockets where some are cyclical and some are secular. And I agree with Yana on the labor cost. It would stick more, but I think about things like trucking costs, logistics costs. And in the short term, it's really hard to see how we can attract more truck drivers. But I think what's going to happen is if price goes up, human innovation kicks in and thinks about, okay, how can we use innovation? Entrepreneurs will jump in and try to figure this out. So there is always a force of price inflation. But at the same time, there's always profit or windfall sort of excess return that's going to be competed away. So I think, for manufacturing or other goods and services, I'm excluding labor here, but price of goods, there has been a deflationary pressure, and we cannot underestimate power of technology and automation because that's more an option than ever before.
And Sonali, coming off the PIMCO secular forum, it's that our timing could not be better. What is the view at PIMCO as far as whether inflation is going to be transitory or sticky?
Sure. So we do believe that inflation will be peaking this year.
Oh, you do?
I think it's quite clear that, there is inflation. We must acknowledge that. And we're seeing it in so many different areas, whether it's a shortage of labor, whether it's due to actual goods that can't come off the ports, whether it's due to, the price at the pump. However, I think it's important, even when you look at, what the break-even inflation rates are implied for future in the marketplace, you can see that the expectations are for inflation over time to normalize a bit. Now, what we call normal has also, has to be, must be discussed, because for years we've fallen short of the Fed's long-term inflation target of 2%. And I think with that, it would make sense that the Fed is using this transitory narrative and will allow an overshoot, given they had to allow the undershoot for so long despite all their efforts and the sheer capital that was put towards, trying to see that level normalize while welcoming employment back. And so when I think about the longer term and kind of 2023 and beyond, we will come off of these levels, absolutely. But, anywhere in the above 2% range, which, the view is that it's going to be in that 2 to 3% type range, is still a pickup from where we were. I think there's a lot that we're watching as indicators. So in terms of rent prices, in terms of wages, that can give us further indications of where it's headed. But I think one important part is that, as much as we're seeing inflation due to some of these global supply cycle interruptions, there hasn't been a technological change or a secular change that's going to shift demand for, such that this inflation need be persistent. Hence why we think, I think transitory is probably too short, but persistence probably too long, because we really are seeing inflation. But it's a question of, I don't think we've seen a secular shift that's going to cause persistent inflation.
And what about interest rates? And Ellen's point is that most governments, and the U.S. government certainly cannot afford to have interest rates go up a lot. I mean, we had a guest on recently. I think that over 50% of the outstanding debt of the United States, the treasuries, mature in 3 years or less. And I think the average interest rate is something like, 1.3% or 1.4%. So if they have to be rolled over at a higher rate, it's going to cost, billions of dollars more in interest. So what about interest rates? What are you talking about at PIMCO?
Yeah, I think to take a step back, the Fed hasn't even yet embarked on. We're about to embark on tapering of asset purchases in the Treasury and mortgage-backed markets, and so there's a lot that has to happen and has to go well before we're raising rates. Right?
And tapering means that they're going to stop buying the treasuries and the mortgage bonds that they've been buying ever since the global financial crisis, right?
Right. I mean, clearly they've lessened the amount they were buying. They're buying less than they were buying, say, last March and April. Right. However, we're still reliant somewhat on the Fed for even the supply and demand of those markets. So, I think we're getting ahead of ourselves when we start talking about the Fed raising rates, because, let's see how this goes. Let's see how the inflation picture evolves. And then, we had said it was a very late 2022 or early 2023 event, really, for to see the Fed hike rates. And even still, you can see the Fed publishes their projection, what they call dot plots, to highlight kind of where they think rates are going over time. And it's still pretty modest in terms of, over the near future. So meaning, I think there's a lot of acknowledgement, even from the Fed, that there's a lot of uncertainty there. Again, highlighting those kind of fat tails of the distribution. And so I think it's almost too soon to worry about, the Fed hiking, even if rates do rise and curves say, the curve shape has also become really difficult to predict because of the uncertainty of even the Fed path.
And let me ask each of you about the speculation that we're seeing in the markets. Rampant speculation, record IPOs, and we've seen these record SPACs, these special purpose acquisition companies. I mean, Donald Trump's media company, we have no idea what it is. It came out recently, and the price just soared in value. And then we've got these these NFTs, these non-fungible tokens, and we've had meme stocks. And I mean, it's pretty extraordinary. Cryptocurrencies soaring. So how concerned are each of you about the speculation that you're seeing in the markets? Is it kind of a warning signal that the markets might be way ahead of themselves? Yana, first, your point of view.
I think it sort of demonstrates the search and zest for sort of risk-on opportunities from the marketplace. I think SPACs are an interesting structure because specialty purpose vehicles, because they've been around for many years, but somehow we've resurrected this idea by a few sort of outliers that have done really well. We don't talk about all the other ones that haven't, right? And the fact that there's a very short-term period during which you have the success and kind of identify
2 years.
The target. Exactly. So we don't talk about all the failures. We sort of focus on what I would call the FOMO, which is why, there's so much interest behind it. On the flip side, there have been legitimate companies that have come public through that venture. So I think it goes back to the points that we've all discussed and Ellen was highlighting, which is you need to be selective in what you're looking to get. I also think that private equity markets have shunned or have kept retail investors on the sidelines, and SPACs have been sort of the first form into that sort of private equity venture that has been allowed. And I think technology has enabled that access, right? So we've had this truly transformative structural change where it is allowed to have investment. That being said, I think it says a lot, which is there's a lot of interest in the investing. Value is in the eye of the beholder, which I think talks about price dispersion and opportunity set. You have a traditionally GARP manager like me and Ellen, who is on the value side, and we probably would assign different fair value to different equities. So I would say proceed with caution and invest in what you can understand and you can ascribe a value to based on what you know today.
Sonali, speculation in the markets, and I have to tell you that, I mean, for probably about 10 years that so many of my guests have been absolutely wrong about the thinking that bonds were way overpriced, that they, possibly couldn't rally anymore, that interest rates couldn't possibly go lower. So, talk to us from your vantage point in fixed income about the speculative nature of that market.
Sure. And even from an equity perspective, if you look at price to earnings, we're at unprecedented levels. And
right.
So shifting to the debt side, valuations, especially in developed market corporates, are at near tights, even of the range, and so now it's a question of, has the Fed, having stepped into corporate credit markets for the first time last year, does that change the range such that you could see tighter tights down the road? Is it that the high yield market, now that it's better in quality than it was even 10 years ago, despite all this debt creation, we have more double B credits rated double B rather than triple C, for example, than we did 10 years ago. Does that shift, again, the range? So there's a lot of, changes to the market over the last, 10, 20 years. Even from a liquidity perspective, right, where the dealers community used to be in control really of the liquidity, and with Dodd-Frank and regulation post Great Financial Crisis, that transfer of capital when you see outflows and the market gets choppy is also changed a lot. And so when we think about valuations, I think it's hard to say it's not full here. It's pretty full. However, there's a lot of opportunity for, being selective in that credit selection process, working with our research analysts to really identify companies that could become rising stars and shift, say, from high yield to investment grade, for example. Because if you look at where average double Bs trade versus triple Bs, you can pick up 100 basis points. If you have that call right, there's some real spread tightening potential. So, again, despite pretty full valuations, we think there's a lot of opportunity in getting the credit calls right from working with our bottoms up perspective. And also there's the opportunity in the recovery trade still, right? So where,
And the recovery trade meaning, what does that mean?
Reopening trades. So meaning if we look at non-cyclicals in the credit space and where they were trading versus pre-COVID, many of them are at their tights or through their tights. And then whereas, there's still some spread premium left in many of these trades in the sectors like gaming, cruise lines, airlines, which even though the path is quite clear here in developed markets that we will reopen more and more over time, we still don't have very many ships cruising, for example. And so there's still some risk premium there that's uncertain in terms of, will the demand be there? Will they get into the water? Will there be a new variant that makes the timeline take longer? And so, there's still plenty for us to do in terms of, despite limited dispersion and tight absolute spreads, there's still a lot of opportunity from a credit selection active manager perspective. Although, I think we have to acknowledge that we've rebounded very considerably from last year.
Put on your trader hat for a moment, and you mentioned liquidity, and certainly there were a lot of, one of the kind of the famous sayings after the global financial crisis was, the markets are liquid until they're not. And the fact, that there aren't the kind of dealers that you had that would take inventories of bonds and that would make a market in it, that they've kind of disappeared after Dodd-Frank. So what is the situation with liquidity in the fixed income markets, and where, could you run into problems if suddenly kind of people start running for the exits? Where could you sell, for instance, if you wanted to sell, or what's available to buy as well in this search for higher yields?
Yeah, absolutely. I think there's some concerns from the dealer community no longer being able to kind of quote unquote store these securities on their balance sheet.
Because banks can't do it anymore
now, rather than the storage business.
Yeah.
The fact that there's less hedge funds out there, especially in the credit space, in terms of where there's less funds that are shorting securities, and therefore they would be the incremental bid if markets were to materially weaken. However, on the flip side, with technology, with data, there's also more, we have something now called portfolio trading, where you can, put out for bid or for offer, say 50 different bonds, 2 million a piece, for example, and get filled within 15 minutes within the context of the market. So, while that's not going to take enough of the liquidity situation, but there's also ETFs, which have become bigger. And now, they are marred in many of the issues around, pro-cyclicality, absolutely. But I think there's a lot to think about there. And from our perspective, it's why it's so important to have flexible mandates and such that we can manage that liquidity, whether it's with derivatives, with cash bonds, and really build a robust portfolio from the top down construction perspective, whether that's, using cash, using derivatives, as well as making those single name selections and building it from the bottom up as well. And so, I think at PIMCO, it's a bit of a unique position where we have a lot of top down thought leadership, right, but yet we still have, about 70 analysts globally that are helping us build from the bottom up as well.
And let me switch to basically what you're telling clients. And Yana, I'll switch it over to you. In specialty solutions, for instance, I mean, just quickly, what does specialty solutions mean? And I mentioned tax advantaged investing. What are you, just drill down a little bit more for us about what you're telling clients from the specialty solutions perspective, Yana.
Well, it's a fancy word of basically managing for high net worth individuals. And the biggest sort of focus for those individuals is diversification and tax management. So really focusing on products that really think about not just what you earn, but what you keep. Right. So really thinking through after tax returns, all the boring stuff like lot detail accounting, harvesting losses, which basically means that, you harvest a loss in a position in a stock you got wrong because it allows you to offset gain somewhere else in the portfolio. So on a net basis, you have lower distributions and therefore lower generation of cap gains, which equates to a lower tax bill for clients. So eye toward after taxes and also focus on long-term investing. I think one of the most important things that we've all talked about here is really walking away from this sort of short-sightedness and trading toward what are we investing in? And investing really comes down to being an owner alongside the corporates that you're investing in. So the two and two are really focused on that sort of trajectory.
Mm-hmm. And Ellen, what are you telling clients at Causeway? You mentioned some of the things basically in your opening remarks, but drill down a little bit more as far as in the investment climate that you've described. What are you telling clients you're doing? What strategies are you employing?
So I think, it needs to be mentioned that, we've gotten a lot of questions about value investing been dead for the last decade because, valuations are not relevant or, growth has really outperformed the market. So
which it has for 10 years about, yeah.
And, of course, falling rate environment, that's a very difficult operating environment for value to outperform. I think for us, what we've been telling our clients is that, we do what we know how to best to do, which is, stick to our process, looking at valuations and, frankly, also try to make sure we avoid value traps. So that's going to be mitigated by, bottom-up research where we want to invest in companies that will have a better position in the market from today with the benefit of time. So I think for us, especially in the current environment, where valuation is high in almost every single asset class, I think our point is to say that, stock selection is very, very meaningful. You have to pick and choose. And I think, Yana and Sonali also agree on that. And hence, that's where I think we can differentiate ourselves and don't get sucked into this FOMO investing. I think, somebody may...
fear of missing out, right? Just right. Do not get sucked into that. All right. Which exactly. Means don't chase hot stocks. I mean, essentially, is that kind of what you're saying?
Yeah. I mean, as long as you're guarantee that you're going to get out before it falls. If there's that guarantee, go ahead. But I think timing the market is incredibly, incredibly hard. But again, going back to the process of sticking to what we know how to do and what we're good at, I think is really important. And I hear that from Yana and Sonali right now in terms of sticking to what you know and just being consistent.
But I mean, I was looking at the Causeway International Value Fund, which is rated gold by Morningstar. You just got a top rating. And talking to Sarah Ketterer, who is one of the founders of Causeway, just about the incredible, deals that you were seeing of companies that were in very good financial shape, that the stocks had just been beaten down to ridiculously low levels. From your perspective, so what are you telling clients now? Have the values rebounded? I mean, have the stocks come back, the recovery trade? So what are you telling clients?
So if you look at, a benchmark that we often quote in the market called EPA, which is a developed market international index, for this year to date, value actually has been outperforming the core benchmark. Right. And I think from a cycle perspective, when you come out of a downturn, this is when value stocks tend to outperform, because a lot of value stocks actually have an overlap with a lot of cyclical stocks. And, during the downturn, we quickly repositioned our portfolio to position ourselves in the cyclical stocks where, earnings were shot. There was no earnings, and people just, fled because, the cruise lines were shutting down, the airlines were not in the air. So I think for us, we really rely on financial strength of a company, because you need to be able to weather the storm and reinvest in business when your competitors are weak. So we are very comfortable, even if the company has no earnings in the short term, if they have financial strength to come up the cycle as a winner. And I think we have many examples of such success stories in our portfolio already today.
Mm-hmm. And also due to the diversification point that Yana was talking about as well. So Sonali, what are you telling your investors as far as your investment strategies? What are you doing?
Absolutely. So I think, one of the things investors have really poured in a fair amount of money over the last couple of years into credit markets. And you can see that absolutely in investment grade, especially. And then that's due to the search for yield, right? It's just become it's very difficult, despite our discussion about inflation and rising rates. We're talking about off the pretty low level. And when we put it in the historical context, rates are still very low. And with that, the search for yield globally, given how many geographies and developed markets have negative rates,
negative yields.
In fact,
right,
and negative, right. So it's really led to a search for yield, and as a result, a lot of demand for credit markets. We're seeing what we're telling our clients is that a diversified, long-term oriented strategy where you do give the manager considers flexibility, liquidity, and as a result can take advantage of those tactical opportunities. Tactical opportunities meaning opportunities to switch, say if a bank loan becomes more attractive than an unsecured high yield bond or vice versa, and really looking up and down the quality spectrum as well as the capital structure for opportunities. And again, looking for those at this point in the cycle, it's very clear that the returns are not about the betas are not obvious. And so it's much more around finding that, being selective and finding those alpha opportunities.
So this is my final question for all of you in the investment section of our discussion. And that is, at the end of every wealth track, we always ask each of our guests if there's one investment that we should all own in a long-term diversified portfolio, what would it be? So Yana, I'm going to start with you.
So based on compliance, I cannot give you stock recommendations, but what I will say is start investing. Time is money. The earlier you start, the earlier your chances and higher probability of you accumulating wealth. And don't time the market. Invest in the market. Invest in stocks of companies you consume, products you consume. Buy what you know. You won't do poorly. You'll do very well, and give yourself time.
Good advice. All right. So Ellen, what would you recommend?
I would recommend that people take a look at international equities. In the context of developed markets, US equities have been on fire and have really outperformed the international markets. But if you look at the composition of what comprises the index, I think there is a lot of cyclicality, more cyclicality in international equities today. And again, US S&P 500 is really dominated by the FANG, the top 5 stocks, which comprise more than 30% of the index, or around 30%. So I would, recommend people to take a look at the asset class. You always want to look at what's been lagging, and don't pay for something more than you should.
All right. Sonali, what's your, we'll finish this part of the conversation with you. What's your one investment recommendation?
Yeah, I mean, I think absolutely, time and compound interest is certainly attractive. But I think, at this point in the cycle, if someone were starting, it's important to realize that with the amount of spread compression we've seen in fixed income markets and with the absolute level of yields, being in a diversified multi-sector credit type mandate where the manager can manage liquidity, have the flexibility to rotate and make those changes as they appear, because sometimes the opportunities in the market are pretty short-lived. If you recall back in December of 2018 when we had that liquidity crunch, being able to shift sectors can take time, and if you have the flexibility in the mandate, you can take advantage of dislocations while having a core structural trade on as well.
Right. So this is a time when professional management can really make a difference in that sort of flexibility. All right, so let's switch to careers. And I mentioned in each of you that I intentionally mentioned the fact of what basically what your educational background was. And I did that for a reason, because I want to know what difference it made. And so Yana, I'm going to start with you. Business administration degree from the University of Florida. Did you have any idea when you were an undergraduate that you would end up being a portfolio manager at Eaton Vance? And how important was the choice of that degree?
I did not. I just know that I wanted to be in finance. I actually wanted to be in international business and wanted to move away until I did an internship abroad and realized I missed my family too much. So the truth of the matter is I didn't know what I wanted to do until I got into a firm that allowed me to just, practice different skill sets and kind of find myself in the path that I am in today. But what it did do for me is it exposed me to a lot of different classes and coursework that I really enjoyed. I loved statistics, and I think that has given me an appreciation for risk management and tools that I use in portfolio construction. I love business administration, learning about businesses and just basic economics 101. Some of the basics allow you the foundation to kind of find your passion. So I would say take as many crazy courses as you can, because you never know what you might end up loving. So it's been great in that sense.
So, and Ellen, you also business administration at Seoul National University. Any idea that you would, you would become a portfolio manager when you started with your undergraduate degree?
No, but I think I knew I wanted to be in the corporate world, somehow learning about companies and understanding, what moves the economy. And I felt like going into business administration would allow me the set of tools that I could acquire to have most amount of choices upon graduation. And I entered banking, and after understanding the financing side and corporate action side of the business, working with corporations, I realized, I wanted to manage money. And my Stanford MBA allowed me to sort of reboot and get access to that opportunity.
Right. And talk about that, what I mean, number one, what was the time between when you graduated from university and got your MBA, and what went into that decision?
Hopefully I don't ramble on, but I have a sort of a different path than a lot of other people. So I realized after 4 years working in banking, I have been promoted to the next level where I didn't need an MBA, but I felt I wasn't doing myself justice unless I gave myself time to reflect. So I decided to apply to business school. And after I applied, I found out I was pregnant. So I worked for 5.5 years, and I took a year off before going to business school because I had my son. And when I was in business school, I had my 11-month-old. So not the real conventional background, but if I could go back and do it differently, I wouldn't do it any differently. And I think the choices that I've made, I think, was really focusing on figuring out, what I wanted to do and prioritizing myself. And I feel all the other things you can figure out and entangle. I don't think there is ever a master formula in how to progress in your career. I think the ability is upon oneself to untangle and figure out the best path. And I think I'm a living proof of that. So I'm, not really the conventional 2-year, work environment, 2-year business school,
right,
find a job, but it's worked out for me.
We'll go back to that because that is a fascinating twist in your career. It's certainly not a common path that most people take. So Sonali, undergraduate degree in economics at Princeton, didn't go for an MBA, right? So, talk to us about, did you know at Princeton, that economics, that the financial services industry was where you would want to be? Did you have any idea you would end up as a portfolio manager?
Sure. So at Princeton, I did have an indication that I would end up on quote unquote Wall Street. I had taken a internship after my sophomore year at Goldman Sachs, and then had come back in. So at that first summer I spent in debt capital markets. I came back a second summer and did sales. And at that point, and that was more of a broad sales group, so I'd gotten to see a lot of different products. At that point, I realized I wanted to be committing capital. I wanted to be in the driver's seat of that. And so I had decided I wanted to be a trader. And more than even being the conviction of being a trader, I had decided that I wanted to be in a product that was evolving and new, and had margin, meaning where we bought it and versus where we sold it had a real opportunity to make profit. And in order to make profit, that means you also had a real opportunity to take risk. So it was a fair amount riskier than, say, trading short term.
And this was at JP Morgan, right?
So then I joined full time at JP Morgan, which at the time was kind of the powerhouse for credit derivatives. It had a much larger desk, all the way down to a full desk of high yield credit derivatives traders, which, at the time during my internship, they had one person who was possibly, straddling high yield and investment grade to some extent. And so just highlights also just in 1 year's time, how much financial markets can evolve. So part of that has to do with, yes, the firm, but another part has to do with the evolution in 1 year and the amount of growth you can see in financial markets. And that to me was very exciting, the dynamic nature of the markets. It's hard to say that I knew I would be a portfolio manager. I would say no, I didn't know that going in, but I did really enjoy taking risk. And, and since I enjoyed it, I kind of never ended up back at business school, which was not something I knew. I kind of expected I would always end up back at school. But I didn't, obviously, as, in the path that I was in, it was not at all prerequisite, nor was it. It was actually kind of taking 2 years of experience away from the markets, because the more you see in the market, the more you can adapt and understand, regime change, different environments for trading and the like. And so, I would say, though, one thing I wanted to highlight, despite my having a lot of conviction in my path from the perspective of economics and Wall Street, it absolutely is an area where you do not need to have a degree in finance, economics, business administration, or an MBA. This is very much a environment for a dynamic, high performing, what we call athlete, like, someone who can work in a wide variety of environments across a wide variety of demands. And frankly, if even, a philosophy major could do very well here, as long as they knew, say, the basics of bond math, for example, in my world, or, whether it's understanding equity valuation, and much of that is learned on the job. So despite my path, I don't want anyone discouraged, because I truly do believe that this is a learn on the job type of environment, and it's fast moving. So what you learn in a textbook only applies so far, past, say, the first few months.
That's fascinating. That's the way I feel about the financial industry as well, that it's pretty wide open to a certain kind of individual who's willing to learn. But that's what the kind of advice that I'm going to get from you all, not from me. But I want to ask each of you, and I'll go back to Yana, Yana, what difference has it made being a woman, or has it made any difference at all in your career?
Oh, that's a tough one. You didn't give us a preview of that one. Let me say it like it is. Majority of the time,
go ahead.
I'm the only woman in the room. The statistics about 11% of PMs being women. I'm usually 10% of the room, which means that in a room of 10, there's not a lot of me looking back at me. But I've been fortunate where I've been surrounded by great partners and stewards and great investors that I've never felt like, outside of having a different sex from them, I've never felt like I was looked down upon because of that. It's because of our business.
Or that you were an outsider. You didn't feel like you were an outsider.
No,
right.
Our business, and that's the beauty of this, and this is what sort of Sonali talked about, is it's very transparent whether you're good or bad. And the truth of the matter is, every day somebody's having a good day or someone is having a bad day. But it's all about your record, and it's all based on meritocracy of what you're doing and the job that you're performing. So I think it has been a benefit, because I haven't been surrounded by a lot of people like me, but ultimately it comes down to a person and an environment you put yourself in, and the opportunities that you take on, which means that you have to have this growth mindset and this ability to say yes more than you say no, because it is risky, but it's the only way to continue to grow professionally and personally. So I think it's a good thing.
And Ellen, let me ask you the same question. I was really intrigued by your saying that, that you went to business school with your son, right? You have a son. I'm sorry if I just remind me. But so what difference has it made being a woman to you professionally, Ellen?
I think in the beginning of my career, I used to think that, I was in an industry where, meritocracy is the pure methodology in which I'm assessed. So, gender is not really that relevant. But as I progressed in my career, I definitely believe that having more women in this industry would be more profitable for our investors, because, I don't want to generalize on gender traits, but you can generalize a statement saying that women tend to be better managers of risk, thinking about downside risk more so than my male counterparts. And, in equity investing, that is very, very important. You have to take risk-adjusted return analysis for investments that you make. And I think there's a lot of stats that show having more women on board tend to have stocks do better. If you have more women portfolio managers, women as a group tend to outperform, male portfolio managers. And again, bringing the point that Yana said, you can have all these different skill sets come and complement each other in an organization. So I think the ultimate important thing for me is I want to be in an environment where everybody's differences and their strengths are respected, but also their weaknesses are complemented. And just like Yana, I've been very fortunate at Causeway to be in such environment. But it is true, when I go into the room, I am the 10%, like I'm one of 10. And I think, at least for me, I've had so far a very fulfilling, financially rewarding career. And I hope more women can, join the industry, because it's an industry where I think people who are highly ambitious, but also are willing to put in the work and can be authentic to their thinking, can really have a successful career.
And Sonali, the same question to you, and listening to Ellen saying about how women have a kind of a different maybe manage risk better. If that's fair, Ellen, of what you said, and certainly all the research that you mentioned as well would back that up. But Sonali, again, thinking about the trading floor, and that you love taking risks, you love being in that position. So what difference has it made being a woman in your career, and as far as how you handle risk? Has it made any difference?
Sure, and I'll differentiate first from my sell side days as a trader, and then kind of more as a portfolio manager.
Yes, on
the buy
right.
side, because it's very distinct.
Very different. Yeah.
Especially given the timing. So in the early 2000s on a trade floor, the culture was quite fraternalistic, as you may have guessed, and the reality is that was true. So it wasn't the easiest of environments, absolutely, but I'm also the youngest of 3 children. I had an older brother and sister, so I was kind of used to it rolling downhill, and I was kind of ready for it. But that doesn't make it easy, and it doesn't make it welcoming per se. However, on the flip side, and part of the reason why I highlighted, what area I went into, being that credit derivatives were new and exciting, it also, not only were our clients kind of excited to pick up the phone and hear someone different, and that was really a welcome, like, wait, what? Who is this? The flip side was that I also had a lot of value because the product was new and evolving. So meaning, when I would trade high yield bonds, many of those relationships had been integrated for over 20 years, talking to, maybe even on the same sector. So my coming in and entering that market was relatively difficult, despite whatever edge I may have thought I had. Whereas coming in through the derivative side, many of our clients that had been in high yield for a long time still were not very familiar with derivatives. We're hoping that that they truly were, as Buffett said, weapons of mass destruction, and they would go away, or that over time, they wouldn't need to learn it. When they realized it was there and it was staying, I turned into a resource for them, where it was like, okay, well, tell me why this trades wide or tight to the representative bond.
So you became the expert.
Well, right, with the salespeople internally, as well as with our clients externally. And that really helped, because now I could start to extricate some of the business from the cash bond side as well, right? So being able to put in that time on the derivative side allowed me to start getting some business on the cash side as well. And so altogether, again, I think that highlights the importance of kind of looking at what's evolving, and because financial markets are always evolving, and sometimes crashing, in fairness, and certain products never came back post-great financial crisis. But I think that was a great equalizer, because it didn't matter what my gender was. It was a question of what did I know going in, and where could I, over time, build, certain relationships take time. That's a fact. In terms of, being a female on the buy side, I would say it's a much more positive experience right from the get-go. And in part because, certainly at our firm, we believe very strongly in the cognitive codex. And to anyone who's new to this is about all the different ways in which, there's unconscious bias, conscious bias, and one day, if I could, I'd follow up and show you this crazy brain map of, all the different ways in which you could be skewed by your experience. Mm-hmm. And as a result, it's so important to have diverse investors in the room. I won't go as far as to say that necessarily women are better investors, even though, yes, Ellen, I've read the same Morningstar study. I think it's more important to highlight that, diverse teams absolutely will get better results because they're able to think about a wider number of scenarios. They have a greater appreciation for, even from an international perspective, the different things that would impact markets, and maybe they've experienced inflation having grown up, say, in an emerging market, if that's the case for someone, and it's very different than, as Consuelo very clearly articulated earlier, that some people here haven't even seen inflation in their lifetimes, and so I do think that diverse teams absolutely is a positive, and it helps, again, it's not just about who in the room looks like me. It's much more around, as a result, how can we drive results because we're able to cast a wider net and think of a wider number of scenarios.
If each of you wanted to hire someone in your respective teams, what's the most important quality that you'd look for? Yana, do you want to take that first?
Sure. I'd say growth mindset, an ability to be a sponge, just this eagerness and curiosity to learn. You don't have to know the answer to every question, but I'm looking for you to work really hard in getting to sources that can lead you to the right outcome. A team player, someone that possesses this just genuine interest in the business and wanting to do well for the sake of the team.
Ellen, same question to you. What would you look for when you're considering a candidate?
I agree with all the qualities that Yana mentioned. I'm trying to see if I can find something different, but I guess I will zone in on two things. One is the curiosity aspect. I think that's sort of the underlying foundation of wanting to be a learner, wanting to know more, and being able to get to the bottom of an issue to make the right judgment. So I would say, curiosity is one. And then the second point is just being, having tenacity, like not settling and always pushing to improve, whether it be, your accounting skills, or is it your investing skills, or wanting to improve the team, the firm that you belong to. So I would say those two things.
Walt Disney called that plussing, is that to make that extra effort when everyone else says the job is done, and he would say to his animators, no, it isn't. You can do more. So the tenacity and the plussing are really important qualities. Sonali, what do you look for when you're hiring a team member?
I think a passion for markets, because markets evolve, but if you're passionate about, and whether it's, right now you may not be passionate about investing because perhaps you haven't even done it, but you're watching markets and you're aware of, what's going on in the broader world, whether that's current events and have an interest in investing. I think the other couple of things, certainly, Ellen and Yana, of course, hardworking tenacity is important. But I think there's one more thing that I want to highlight, which is attention to detail. This is a very unforgiving environment for mistakes in that sense. While we're all human and mistakes happen, there's real capital on the line. And so, having that attention for detail, especially in your junior years where it's one of the ways in which, the next, say, level of responsibility is bestowed is important. And then lastly, I would just say following up and following through, right? In terms of the environment in finance is pretty flat and you have access to a lot of people, and, expressing your interest is great, but then you need to kind of follow up and follow through with, what it is you're interested in or why, or how, looking for ways to add value. I shared earlier an experience from my younger years of, how I tried to add value in a part of the market that was relatively entrenched. But I think that's so important to figure out, what it is you're looking for to some extent, but then also following up with, I think I always say to our interns, and I've said it to even interns in previous jobs I had, which is, the internship is your opportunity to see, is this the right industry? Is this the right firm? Is this the right fit? Am I interested even in markets? And which product might be a good fit? when you come back full time, yes, it's absolutely about producing and performing. But, you know, take advantage of those internships and ask all the questions that will help you to figure out what's the right fit.
So a couple of, you know, final questions before I get to the final question about the one piece of career advice. And so what was the best decision that each of you made, and what was the worst mistake you've made? Yana, you start.
I think one of the most pivotal moments in my career is working on an enhanced indexing product within the walls of a fundamentally biased shop. And in normal language, what that means is basically I was asked to create a competing product to what we were sort of known for. And when I was asked to do that, I literally thought that my manager was looking for a way to fire me and this would be it. But what really happened was, this was 16 years ago, and it was sort of the early innings of what are called risk management tools that really allow for the next generation of portfolio construction, where the two worlds sort of collide, right? The investment management with risk overlay. And that was the best thing I ever did, because I created this product. I was asked to be a portfolio manager of that product. And today this product is billions of dollars in total assets. One of the biggest mistakes that could have been, I will cheat a little bit, is a couple of years ago, I wanted to make a change in my career, partly because the demands of the job, this is before work from home. I know this sounds so crazy right now, but it's a hard job. A lot of us asked of you, you rarely get to turn it off. You are, again, bestowed with great responsibility that takes a lot of hours and ownership, that you're taking care of other people's assets that they worked really hard for. And that was a lot for me. And I wanted to make a change for the sake of my kids and my family. Long story short, I didn't get the job, which turned out to be the best thing that could have happened to me. But I learned that sometimes failures are actually success stories. So in my experience, I got to try this out, fail, but in reality, I think as I reflect back, it was a win. So a little bit of a cheating answer,
right?
But
no, failure is part of the process of succeeding. It really is. So, Ellen, kind of best decision that you made and biggest mistake?
Best decision was to decide to work for Causeway, small boutique manager with great people. You know, when I joined the firm, assets under management was 15 billion, close to half during GFC. You know, we're 45 billion. Being part of an organization where, you know, it's very, first of all, it's very flat, and being able to actually build this organization together with my colleagues and having the ownership and achievement of that process has been remarkably rewarding, because, you know, I'm also growing as a professional, but I feel, you know, I'm growing as a leader and as an entrepreneur. You know, I was like the 48th employee. You know, we have over 100 employees today. So I think that's, you know, very satisfying in multi dimensions. My failure, I did one thing you didn't mention, Consuelo, and I don't know if you did this, you know, intentionally, but I did cover energy. It's a very checkered past,
right?
And I failed to see and recognize a monumental shift of a new supply source called U.S. shale entering the market. And, you know, I learned really the hard way that cycles are similar, but the details are different. So ultimately, I think right now it's sort of playing out as, you know, I had seen back then, but on a more medium-term basis, it was a threatening sort of structural force in the market where, you know, market participants were very wary on how this would impact, you know, the supply-demand fundamentals of oil. And I think for me, you know, maybe I was a little bit too gullible in believing the companies when they said, oh, we exercise capital discipline, all these investments will have high returns. But I learned the hard way, and I hope and I believe I'm a better investor for it. But, being more skeptical and just, not always having to lead a certain trend and being a follower, I think is okay in investing, to wait for things to play out and step in, because there's still more returns to be made even after the fact.
Important perspective to share with us. Thanks, Ellen. I'd really appreciate that. So Sonali, both questions to you as well.
Sure. So, I did mention product selection was one of the key decisions I felt like I made. And, I probably only could have made it because of the 2 internships, meaning I had seen enough to have an idea, whereas often you come in and it's hard to kind of get the bigger picture of what all goes into it. But I think another aspect I would say that was a good decision was transitioning to the buy side when I did, right? So I think the sell side means the dealer community, the banks. They have a lot to offer from the perspective of training programs, big classes of students that are joining at the same time in starting their careers. And so there's a lot of positives. However, post-Great Financial Crisis and having traded in that environment, it was quite clear with regulations that, if I wanted to take risk, that was no longer the job. The job became an agent job, meaning matching buyers and sellers over time. And so, for what I was interested in, which was, investing in companies and ascertaining trends and the like, I transitioned to the buy side where, eventually I knew I would get the opportunity to run capital. And then from there, it was up to me to prove myself. I think that transition was very important for what attracted me to finance as opposed to just how markets work. But I also think there's pros and cons, right? There's certainly starting from the sell side, I was able to see what our competitors were doing now here at PIMCO, those competitors, and also get a better appreciation for different investment styles, which eventually informed kind of how my own morphed. In terms of greatest lessons learned, unfortunately, often the greatest lessons learned are from hiccups along the way, right? Sure. And so I think, despite however many companies I've invested in over the years, however many different sectors I've looked at, it did not occur to me that a company would voluntarily go into bankruptcy with $4 billion of cash on their balance sheet. So, just really, again, forcing, we often ask for a sensitivity table from our analysts, really to look through a wide variety of scenarios when investing and understanding what the convexity profile is to the downside as well as the upside. But that just shows case in point that many times, like, an analyst will come back with a very narrow range, right, of plus minus 15%, let's say. That's not enough when investing, especially in troughs, or, we may not know what a peak is, but a peak. And really, forcing that range very wide to fully understand, what looks like it has downside protection, for example. And, Ellen mentioned energy. Many E&P credits, energy exploration and production credits, if you only stress down to, say, $45 in oil, you don't see where they completely break. Right. And the company's recovery now is single digits, for example. And so again, that highlights that full range and really thinking probabilistically, right? That it's not, despite your base case and despite the fact that, looking down 50% in revenues seems maybe absurd, but okay, what probability do you assign to that? And what's the likelihood?
Yeah, no, really good lessons, hard-earned lessons as well for anyone who's been in the financial markets. So the final question before we get to the questions from our audience. And so Yana, your one piece of career advice that you would give to our audience?
Be confident than you are today and say yes.
Great. That was quick.
It.
Love it. Yep. Ellen?
Just do it. Take action.
And
don't think too much. Just take action. Whether it's investing, job, or anything in life. Failure also have lessons too.
So go with your gut. Is that what you're saying?
No, I'm just saying,
don't overanalyze.
Don't over. Yeah, I think.
Okay.
Just take action one way or the other, because at a certain point, unless you take action, you're not going to reap any benefit from that action itself. And that's an opportunity lost.
Sonali?
I would say embrace change. This is not only is the market ever evolving, even your role will evolve. This is not an industry where you get to think of your 5 to 10 year plan, because despite what you think, there will be a lot of change, whether it's in your product, whether it's in market structure, whether it's in liquidity sources. I mean, this is not that type of environment. And so if embracing change excites you, this is the right place.
And those were fabulous pieces of career advice. So thank you all. And I'm sure we've got some questions from the audience. So Nella Webster, you've been fielding those. So do you want to start?
You're on mute.
I'll help too. So great. And boy, I have to say, this was a wonderful, wonderful panel. Each of you addressed the questions so well. And the interesting thing is I only had a couple of questions that related to your career side of, or I shouldn't say your career, but the business side of your careers. And I have a whole bunch of questions related to the personal side and advice that some of our people in the audience would like to hear from you. So I'm going to just take the two more of the business oriented sides of things. And one of the things that Yana said makes this one particularly interesting, and there may be some questions or answers from other members. With all the disruptive changes in markets, isn't it time to make disruptive changes in how we build portfolios? What innovations need to come forth on portfolio construction? And is anyone exploring a new framework? I know Yana talked about something she had done that's right along this line. And I thought that was just a really interesting question on the disruptive changes we're seeing and whether people are looking at different frameworks for portfolio construction. So that'd be open for any of you.
Maybe I'll kick it off if you don't mind. I love this question because I believe change is the only constant and kind of plays on everything we've been talking about, which is you got to embrace change, adapt quickly, and evolve, right? And I think innovation is one key advice that I would say to all our listeners is it is consistently under sort of appreciated by the marketplace. And the reason why that's important is because your generation is so much closer to technology, which happens to be an enabler of that change, that I would say the most important thing you can bring to any organization, finance or not, is your ability to speak languages that unfortunately I didn't grow up speaking. And I don't mean, Spanish, I don't mean French, I mean Python, I mean languages that can help us go through all this data that's coming at us, all this research we should be reading, and there's just not enough hours in the day that can help us make better, consistent, efficient decisions. So on the portfolio construction side, I think the next generation of investors are exactly what I just described, which is you have the technical skill set to be able to assess the fair value of a company through financial modeling, through the basic analysis of corporate management, questions that you ask them, going to visit sites, doing all that due diligence work, but mirroring that weighted probability analysis that Sonali was talking about, what is my bull, what is my base, and what is my bear case assessment, with whether the stock makes a good add to the overall portfolio through the tools that I was just talking about. So I think it's an excellent point, and I think that's where the industry is going. It's the marriage of the world that shouldn't coexist but must in the world that I think is ahead of us.
Just dovetailing on what Yana said, even though I'm part of a fundamental strategy at Causeway, we deploy a lot of quantitative tools to construct our portfolios. There's a lot of short-term signaling that has proven to be effective, and also understanding, the risk posture of the portfolio, because I myself is an individual stock picker, but when you put it in a basket of all the other stocks, what does this mean? What exposure does this mean? And in this world where there's so much data, being able to really assess and process that data to better your portfolio construction process is definitely going to be useful. And in terms of innovation, I guess one other way I would address the question is, this is very near and dear to my heart in the sense that, when I'm picking stocks or investing in companies, I want to be with the ones that are innovating, not just new products, but are innovating in terms of way they run organizations. Because I think the value traps happen actually not because your inability to just build new products, but it's organizations that have lost the ability to innovate.
Good, good.
Sure. So I think.
Go ahead, Sonali.
Oh, yeah. Sorry. We can move on if preferred.
No. Go ahead. I wasn't sure if you were going to.
Oh, I was just going to say that, I think, Ellen and Yana have clearly hit on technology as a part of the evolution. Certainly AI is going to have artificial intelligence that is a outsized impact on the market in years to come, whether that is through call it challenging what may be historical lows or highs in terms of, trading through them, whether that is just assessing the risks. It also, we have something we call the FedBot, which is able to read through the transcripts, for example, very quickly and decipher, how many times was something said, what could be market moving in well faster than the human can read. Right. The amount of data out there today and the transparency is unparalleled versus, say, when we were talking about earlier, when there was inflation the first time around. Back then, many investors were punching on a calculator the size of a computer called a Monroe. So things have just evolved dramatically. And I think with that technological change, it also means portfolio construction changes. And to be a little bit more specific, with something we look at, for example, is equity, enterprise value, as well as the implied options, what they imply for volatility and how that might inform the credit spread of a company. So something that's a bit more readily transparent on the equity side versus on the debt side. Will also, there's countless signals. In addition to, say, the bottoms up analysis that we do, we will look at, from an earnings release, what's being said. So there's so many ways to kind of use this data. And while our firm is not an algorithmic trading firm, even those exist. And so then kind of how do you beat that? Because that is likely to be the, say, incremental flow in terms of a trade on the back of it. And so, there's a lot of different, I would definitely echo that technology is going to have a major impact on a go-forward basis. And that even while there's always scope for fundamentals, that, being able to process more data quickly will definitely enhance portfolio construction.
Yeah, great diversity of thought there. And it leads right into the next question that's dealing with banks and interest rate increases. And the question is whether banks, and particularly regional banks, should benefit from increasing interest rates or not. And if you're looking at that sector at all, would you favor large banks or the smaller as a play going forward? Maybe an equity question.
Ellen, that's probably right up your alley, right?
Right. I don't cover banks, but I can chime in. Obviously, we have banks in our portfolio. Rising interest rate environment is typically good for banks, as they have a big part of their income comes from this bucket called NIMs, which is net interest margin. So the cost of funding versus cost to borrow. That's how they generate profits. I think from a regional bank perspective, I think those trends would apply as well. But if I think about your second half of the question, which is large banks versus smaller banks, I think in the day of technology and small fintech companies really chasing you down on your business, I think if you're a bigger bank and you can use scale to your advantage to develop and deploy technology to benefit from economies of scale, that would actually benefit the larger banks. And this is why there's been so much consolidation in this sector. And of course, even if you're a regional bank, if you're strong, in your market positioning, in the geography that you operate, and you have strong relationships, I think that could be a niche, but on a more general sense, I think you're better positioned in a larger bank.
Thank you. The next questions, I'll kind of combine them. They go with learning on the job. People were so interested when you were sharing your paths, and Ellen, particularly yours, that's not the traditional path of getting to where you are now. But the question goes back to what are some of the most critical certifications or skills or things that students can do to stand out on their resume when they're applying for roles and internships? I mean, are there important things that they've got to check that box before they should even look at applying for something?
I'll take a first crack at this. I think when you decide and you're in the process of searching for your, for an opportunity, I think, many candidates do very little research on the firm that they're interviewing with or understanding what the company is about. So I think the first step is, of course, you want to have certain credentials. And I think at least, what we've shared here today is, you need just basic skill sets on being curious and being a hard worker. I echo what Sonali said, but of course, depending on the job that you're applying for, there could be certain skill sets that is going to be more highly valued. For example, if you want to be in equity investing, having something to show for that, what accounting is and are well versed in accounting is going to be critical. But of course you can learn these things on the job, and I'll share with everybody here, though, I started in banking and I did business administration. I went through Horngren's, introduction to finance in my first month, after a day's job. I mean, it's not, rocket science. I think people can absolutely process this information. So I think to answer your question directly, you got to know who your audience is, and from there figure out what certifications or what skill sets they're looking for. And because I didn't apply to jobs when there was internet, but because of internet, you basically have no excuse. There is plenty of resource out there that's going to give you the answer to what you need to do.
Great.
Yeah, I would just echo that. And I would say certain skill sets like learning some kind of a sort of language that would help you in data mining and data science, again, Python or whatever else. Software like Tableau that allows one to visualize data, again, not specific to finance in particular, but what can make you invaluable to someone who's going through this amount of incredible data set would be great. I personally look for diversity of background. I want to know what makes you, you. I'm not looking for me. I'm looking for someone that adds to the team. I'm looking for someone that can bring their experience. It can teach me something. Forget about the age. I had an intern who was interviewing. He did everything from landscaping, construction, nothing related to investing. And he was at the top of the list because hard work is hard work. And that's what I look for. And by the way, we're looking for a portfolio manager associate as we speak. So for anyone interested to move to Boston, I would welcome the opportunity for you to look online. I think it's a great gig. So just so you know, there's an opportunity waiting for someone willing to say yes.
Okay, so here is another question that's a little different on it. How much are you looking into environmental changes in your respective fields, especially when it comes to younger generations pushing for green technology and production?
Well, I guess I kicked off the ESG topic earlier, so I'll give it a go. Yeah. In terms of ESG investing, which encompasses environmental, social, and governance issues, I think the trend is clear for an increase in green bonds, sustainability linked bonds. And certainly the sectors in which we'll see more of this are those where, we're higher quality is definitely a starting point, meaning a triple C or a single B credit in high yield. That's not going to be their first priority. They need to be worrying about survival and growing into their capital structure rather than, meeting ESG concerns. However, between double Bs and investment grade, we're seeing a tremendous amount of interest. And I think that when you think about it over a secular horizon, certainly, around what you're hearing from the political side of it, from climate change, as well as just, companies also know, where the evolution is headed. And, one thing you often will hear is skate to where the puck is going in terms of, if the trend is clear, then let's start to issue green bonds and clean up some of the brown issuance, for example. And I think the other part of the question was around green technology in terms of the employees' interest. Is that right?
Yeah.
I'm not exactly sure what they mean by green technology, but I think all of our comments have very clearly hit on that technology is infiltrating financial markets at record pace, even in markets like my own, where let's say that there's been certainly a slower pace of adaptation to technology than in equities, which got electronified very quickly, and as a result, decreased margins and made it more commoditized on a relative basis. There's no stopping the trend per se. It's just a question of how do we handle it and how do we adjust and how does it evolve. I'm not really sure if the person would like to. I'm not really sure in terms of green technology what was being alluded to, but I think there's so much room for data mining, data science in financial markets, especially today.
Just putting an equity perspective on ESG investing, I think there is a lot of interest and hype about ESG because ESG translates into growth opportunities. If this is what the younger generation or the next level of shareholders or next generation of shareholders would prefer, companies are going to react to what consumers want. And if that's going to make their product sell more, capital is going to go toward that area. So this is sort of an interactive process. And for me, as a bottom-up investor, I'm looking at companies that are well positioned to benefit from this growing trend, but it has to be a profitable one where the returns will pay off. So I think that's one thing I'm looking at. And secondly, also companies that are not really joining this trend, because it's not yet profitable, even that needs to be scrutinized, because if the world is going that way, and when the tides do actually turn, are they going to be able to, shift and pivot in a short period of time and have the competitive advantage to excel in that operating environment? So one is about, growth opportunities. The second is about sustainability of your business model in the future in the new world.
And I would just add one last, lens, which is the risk management lens. I think, doing good is good for business. We actually have a subsidiary, Calvert Research, that focuses on only ESG ratings through the lenses of those three vectors that you talked about. And I think as an investor, you have to ask all of those questions as it relates to human capital management, as it relates to security governance, as it relates to all of the things that each one of those buckets addresses. And again, when we kind of assess a company in terms of reward to risk, you kind of want to think about it through the growth opportunity that it would allow this company to capitalize on, but also the risk if they are not doing all the right things, litigation risk, obviously business risk, and other things. So I think there are a lot of important lenses that one can kind of look through when you think about ESG.
Yeah, and I'll also add to that, Yana, that Calvert was one of the pioneers in socially responsible investing. It's been doing it for a long time.
And I've got one final question that I think will be great for all three of you. It's been here now. I've got to get back to it. Sorry. It deals with, have you read any books that have helped you navigate as a businesswoman in a male-dominated environment? And this person said she's reading Invisible Woman, Data Bias in a World Designed for Men. Her question is really, if it's not a female-based book, do you have any good book recommendations that she could take advantage of, or all of us could? So a favorite book that maybe has helped you as a woman in a male-dominated world?
I don't have a favorite book, but I am a podcast junkie, and I focus more on just kind of growth mindset, and how to continue to grow, irrespective if you're surrounded by other women or men. It's all about kind of focused on you, which I would suggest don't make it about anyone else but you. If you do the right thing by you and you kind of focus on what makes you happy, what you like to do, what you dislike to do, you'll be okay. And I think some of the podcasts that I would recommend is How I Build It. I really love it because it's inspirational. It talks through, Guy Raz does this phenomenal interview with some of the best entrepreneurs in the world. And I think what you learn very quickly is all of us experience ebbs and flows and troughs and peaks. And it's important to recognize failures as successes and those pivotal moments. The other one that I would recommend is by Whitney Johnson. She does a lot of work on S-curves, which is your personal sort of plateau and sort of that pivot that allows you to grow, and things that you need to do and expose yourself to. And lastly, I would say surround yourself with people that lift you up, that push you and nudge you. So less of a book recommendation and more of just the way of life to kind of keep growing and keep learning.
My book recommendation is not what you would call a classic investment book, but it's The Undoing Project by Michael Lewis. Great storyteller. And I really like this book, and I found it to be very relevant for the work that I do, because it really points out, how human beings can really make errors in a decision-making process. But we always are overly confident that our decision-making process is rational. So just knowing the pitfalls of where I can be wrong, and this again goes to the fact that this is why I think having a diverse group of a team that can complement each other is very important. But I found the book to be very humbling, and also very relevant to the decisions I have to make every day.
Thank you.
Ellen, that reminds me of when people say everyone thinks they're above average. Quite impossible, obviously. Unfortunately, I don't have a single book to point someone towards. I think, Yana and Ellen have provided some good thoughts. I think, at this stage, it's your curiosity and your hard work rather than what you can prepare with, as much as I'm sure you're eager to prepare. And we love that. It'll come through from a personality perspective. But at least from what I've experienced and what I've seen, I think that there is a lot to share with respect to your passion for markets. But then the rest really, as you can hear from what Yana's looking for example, that these are characteristics of a person as opposed to preparedness per se. Or I guess for fixed income investing, I'd say go read section C of the Wall Street Journal.
Good advice there. And I think time-wise, we're going to need to wrap up the questions and go back for some closing comments. And stay on, please, because there is a survey that's very brief at the end that we'd like you to be able to give us feedback, because we're hoping to be able to continue to do events like this. So I'm not sure, is it going back to you, Consuelo, or are we going back to?
I think we're going back to Angela and Tom.
Yeah, we're going back to our closing screen here.
Perfect.
Yes. Well, wow, this was absolutely a fantastic event. Thank you so much, Consuelo, our panelists who were absolutely terrific. And I think you can see on the screen, the whole team takes a team to put this thing together. Casey, our CMO, Jeremy, who did all the technical work, Rita, who put the whole thing together, and a special thanks to Nella, who forged this partnership with Chapman. So I don't know what to say, except I learned a lot. I thought it was really fascinating. And Yana, thanks for the job posting. That was really terrific. So I hope that all of you will join us for our next Pink Wall event. WISE has an event coming up on estate planning in December, but we will be hosting more of these events, and we'd love your input, as Nella mentioned. Tom, any further comments?
Great job, Sonali, Yana, and Ellen. I was really particularly interested in your, what I thought was relatively optimistic take on inflation, but also the importance of intellectual curiosity that you wrap throughout all your themes, whether in making a critical skill for an investor, a quality in somebody you're looking to hire, and central to your own professional growth. So I thought that was interesting that you all highlighted that from different perspectives. And Consuelo, thank you so much for doing a wonderful job moderating. And Nella, those were really hard questions. That was mean of you to do that at the end of the event. But I also would like to thank everybody that put this on, and Angela in particular, you for driving the whole process and bringing this and allowing Chapman to be a part of it. And so thank you all for participating.
Yes, thanks to everyone, especially our great audience. So I guess we say good night, but do stay on for that survey. Bye-bye.
Thank you.
Thanks, Angela. Bye. Bye all.